Hey everyone! Have you ever felt overwhelmed by the world of investing? You're not alone! Many beginners jump into investing with big dreams, only to find themselves facing common pitfalls that can derail their financial goals. Today, we're diving into the 10 most common investing mistakes, and more importantly, how to avoid them. Trust me, you'll want to stick around for this one. By the end of this video, you'll have practical tips to help you navigate the investing landscape confidently and set yourself up for success. So grab your notepad and let's get started. Not having a clear investment plan. First up, let's talk about the importance of having a clear investment plan. Many new investors dive in without defining their goals or risk tolerance. This lack of direction can lead to poor decision-making and unnecessary stress. Your investment plan should outline what you want to achieve, whether it's saving for retirement, buying a home, or funding your child's education. To create your plan, start by setting specific, measurable goals. For instance, instead of saying, "I want to save for retirement," you could say, "I want to have $500,000 saved by age 65. Then, identify your time horizon, how long you plan to invest before needing that money. This clarity will guide your investment choices and help you stay focused even when the market gets volatile. Remember, a well-defined investment plan is your roadmap. It keeps you on track and helps you resist the temptation to make impulsive decisions based on market noise. So, take the time to sketch out your financial future. Number 2 is trying to time the market. Next, let's tackle the common mistake of trying to time the market. Many investors think they can buy low and sell high by predicting market movements. But here's the truth. Even seasoned professionals struggle with this. According to studies, missing just a few of the best market days can significantly impact your returns over time. Instead of trying to time the market, focus on a strategy called dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. For example, if you invest $100 every month, you'll buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy can help smooth out the effects of market volatility. Remember, investing is a long-term game. It's better to stay committed to your investment plan than to chase fleeting market trends. Focus on building a diversified portfolio and let time work its magic. Next, ignoring diversification. Moving on to mistake number 3. Ignoring diversification. Many new investors put all their eggs in one basket, thinking they can maximize returns quickly. But concentrating your investments in one stock or sector can lead to significant losses if that company or industry hits a rough patch. Diversification is like a safety net. By spreading your investments across various asset classes like stocks, bonds, and real estate, you reduce risk. For instance, if the stock market dips, having bonds in your portfolio can help offset some losses. A common rule of thumb is to consider the 60-40 split, 60% in stocks and 40% in bonds, though this will vary based on your risk tolerance. So take the time to build a diversified portfolio. Look beyond just individual stocks and consider mutual funds or ETFs that provide instant diversification. Remember, the goal is to balance risk and reward. Letting emotions drive decisions. Next up, we have the emotional roller coaster that can come with investing. Fear and greed can lead to rash decisions like selling in a panic during market downturns or chasing hot stocks in a bubble. Research shows that emotional decision-making can significantly hinder investment performance, often causing investors to buy high and sell low. To combat this, practice mindful investing. This means taking a step back when emotions run high and relying on your investment plan instead. For instance, if the market drops and you feel anxious, remind yourself of your long-term goals and the plan you've set in place. Journaling your thoughts or discussing them with a trusted friend can also help you gain perspective. Staying disciplined and sticking to your plan, even in turbulent times, can be your best ally. Remember, investing isn't just about numbers, it's about managing your mindset too. Neglecting to research investments. Another common mistake is neglecting to do proper research before making investment decisions. In today's fast-paced world, it can be tempting to follow trends or take tips from friends without fully understanding what you're investing in. But this can lead to poor choices that jeopardize your financial health. Before investing in any stock or fund, take the time to research. Look into the company's financial health, market position, and industry trends. Utilize resources like financial news websites, company earnings reports, and investment forums. You can also consider using a stock screener to find companies that meet your investment criteria. Knowledge is power. The more you understand your investments, the more confident you'll feel about your decisions. So roll up your sleeves and dig in. Your future self will thank you. Number 6 is overlooking fees and expenses. Now, let's discuss fees and expenses. Many investors overlook how much these can eat into their returns over time. Whether it's brokerage fees, fund management fees, or trading costs, these expenses can add up quickly. A study by Morningstar found that fees can significantly reduce investment growth over time, often by tens of thousands of dollars. To avoid this pitfall, always be mindful of the fees associated with your investments. When choosing mutual funds or ETFs, look for those with low expense ratios. Additionally, consider using a discount brokerage that offers lower trading fees. Every dollar saved on fees is a dollar that can stay invested and grow over time. Remember, it's not just about how much you earn, but how much you keep. Being aware of your expenses can help maximize your returns and set you up for a more secure financial future. Another mistake many investors make is following the herd. It's natural to want to go with the flow, especially when everyone around you is jumping into a hot stock or investment trend. But this can lead to buying high when everyone else is excited and selling low when fear sets in, often at the worst possible time. Instead of following the crowd, focus on your own research and investment plan. If you see everyone pouring money into a trendy stock, take a moment to ask why. Is it a sound investment, or is it just hype? Often the best investment decisions come from thorough analysis rather than popular opinion. Stay true to your strategy, and remember that investing is personal. It's okay to be different if it means aligning with your financial goals and values. Be confident in your decisions, and don't let FOMO, fear of missing out, drive your actions. Number 8 is not having an emergency fund. Now let's talk about the importance of having an emergency fund. Many investors jump straight into the market without setting aside money for unexpected expenses. This can lead to situations where you're forced to sell investments at a loss to cover emergencies, which is never ideal. A good rule of thumb is to aim for 3 to 6 months' worth of living expenses in a separate savings account. This fund acts as a financial cushion, allowing you to weather unexpected events like job loss or medical emergencies without disrupting your investment strategy. Building this fund takes time, but start small. Set aside a portion of each paycheck until you reach your goal. Having an emergency fund in place will give you peace of mind and help you invest more confidently. Ignoring tax implications. Next up, let's discuss tax implications, an area many investors overlook. Different investments are taxed in various ways, and understanding this can save you a lot of money in the long run. For example, long-term capital gains are taxed at a lower rate than short-term gains, which can significantly impact your investment strategy. Make sure to consider tax-advantaged accounts like IRAs or 401ks, which can help you grow your investments tax-free or tax-deferred. Also, keep track of your investment losses, as they can offset gains and reduce your overall tax liability. This strategy is known as tax loss harvesting and can be a powerful tool in managing your investments. So, take the time to learn about the tax implications of your investments. Consulting a tax professional can also provide personalized advice tailored to your situation, ensuring you're maximizing your returns while minimizing your tax burden. Not reviewing your portfolio regularly. Last but not least, we have the mistake of not reviewing your portfolio regularly. Once you invest, it's easy to set it and forget it, but that can be a costly error. Markets change, companies evolve, and your financial goals may shift over time. Failing to review your investments can lead to a portfolio that no longer aligns with your objectives. Set a schedule to review your portfolio, maybe once a quarter or twice a year. Look at your asset allocation and ensure it still reflects your risk tolerance and goals. If you notice that one sector has become too dominant due to market fluctuations, consider rebalancing to maintain your desired allocation. Regular reviews also allow you to stay informed about your investments and adjust your strategy as needed. It's your financial future. Stay proactive. And there you have it. We've covered 10 common investing mistakes and how to avoid them. Remember to create a clear investment plan, resist the urge to time the market, diversify your portfolio, and stay informed. Your investing journey is just that, a journey. If you found this video helpful, please give it a thumbs up and subscribe for more personal finance tips. I'd love to hear about any investing mistakes you've learned from, so drop a comment below. Thanks for watching, and let's continue on the path to financial success together.